A lot of accounting firms are just not delivering business clients what they need. And so they've opened the door for someone who's going to run these CPA firms a lot more like a business. They're going to run them in a way that's going to really optimize those firms. I'm Brannon Poe, and this is the Accountant's Flight Plan podcast, where you can enjoy engaging conversations about mergers and acquisitions and accounting practice management. Listen in on strategies to build a more fun and valuable accounting firm. Welcome to the Accountant's Flight Plan podcast. I'm excited to have two team members on today to talk about a subject that's very interesting in the profession. It's about private equity. So before we kick it off, a little bit about our guests. First of all, I'm Brannon Poe. I'm the founder of Poe Group Advisors. And we have Lawrence Ball and Morry Brown on. Lawrence, how about give a quick intro before we get started here?
All right. Hi, I'm Lawrence. I have been working in business development for over 15 years, starting in New York in wholesale home decor, also worked in the drone industry, and now been with Poe Group Advisors selling CPA and accounting firms for the last 4 years. And Morry, tell us a little bit about yourself.
Sure. I'm Morry Brown. I spent about 15 years working in institutional capital markets in New York at investment banks like Goldman Sachs and Citigroup. I've also spent a number of years in the private markets, primarily facilitating transactions, selling a couple of businesses to publicly traded companies. And then since 2021, I've worked at Poe Group Advisors, leading the California market.
All right, guys, thanks for that. And yeah, this is an exciting topic. It's one we've got a fresh white paper out. We'll put that link in the show notes. But I want to get right into it and give people just an overview of where we are in our industry. And this is going to be a cycle. I think you're going to see a cycle of consolidation, and we don't know how long that cycle is. We've kind of studied some other industries like financial services, veterinarian, dental practices. Those have kind of gone through a wave of consolidation prior to our industry. I would say we're 2 to 3 years in. Our experience at Poe Group is we started to see private equity really making an entry into the smaller practice market. Last I heard, I think over 25% of the top firms are already taking private equity money. So it's really hitting the larger firms, but we're seeing it come down into even smaller firms. I don't know how long this cycle lasts. My best guess is 5 to 10 years, and we're probably 2 to 3 years in. So there'll be a lot of consolidation. I think you'll see increase in valuation. You'll see increased demand. You'll see some messes being made. You'll hear of some failures, and you'll probably see some awesome firms come out of this, with a really winning strategy. So it'll be an interesting time for our industry. Lawrence, I got a question for you, and that is, you work with clients at looking at all sorts of different buyer types, and I think there's already a little bit of a negative bias around entertaining buyers that are backed by PE. And so we're pretty, we want our clients to have a good fit and a good experience. And PE is not for everybody, and we're pretty clear about that. So can you speak to that a little bit about what your kind of conversations you're having with clients around that?
Yeah, I think PE is right for certain types of sellers and what they're looking for. I think when a seller's thinking about what they want, do they want to stay on longer? Do they want to maybe keep a little bit of equity and be part of like the ride with private equity growth? I'd still say the majority of our sellers, they feel like it's not the right fit. And I think really what you want to see is, what type of private equity firm is it? How are they going to help benefit you? What do they offer? And really, do you also enjoy working with the buyer too. I think, you really want to focus on fit and what's right for your firm, yourself, and especially employees and clients as well.
Yeah, and what you said about just the fit is even a bigger consideration when it's private equity. If the seller is going to stay on for a couple of years, you got to think not only, okay, is this exit right for my clients and my staff, but how's that relationship going to be post close? Am I going to enjoy working with this person? And are they going to treat me fairly on the final exit too? All those things are come into play, right?
Yes, because I do see what the majority of what ideally private equity wants is that a buyer stays on for like 3 to 5 years. It's not always the case, but that's a lot of times what they're looking for to be a part of the growth and journey.
Yeah. And you've had a couple of deals where you've got multi-partners and sometimes maybe one or two partners is really ready to exit and the remaining partners want to stay on longer. And so that's actually been a pretty good fit for PE in some cases.
Yes. Yes, definitely. I think like if you have, especially with sellers, when there is multiple partners, each person wants different things. So finding the group that is gonna help them get to the next level, and especially someone who's very energetic and wants to continue expanding and can really, I think a lot of times where PE does help is taking some of the admin work off and the ownership role, that sellers a lot of times are ready to stop working on that and really focus on more like growth, business development, not as much the IT problems, the recruiting, things like that private equity can help with.
Yeah. Yeah. And they're not all the same. I think there's a lot of variation in private equity firms. They have different approaches, they have different team members. It's really, you have to evaluate those buyers just like you would any other individual buyer, right? Like they're they're not all the same by any stretch.
No, and definitely I think there's some that want to buy and hold and they want to keep the name. And then there's others that in 3 to 5 years, they're probably going to flip it to a bigger private equity company. And so do you want that for your firm? I think is the question as well.
Yeah. And I know we're going to get to valuation, but want to mention that since you talked about the whole selling to another private equity firm, a lot of the driver in this is that these firms are consolidating and they're making a larger firm, and that is the value that they're adding into the marketplace in essence, because a larger entity is going to be more stable, it's going to be more predictable, and that way it'll kind of be more marketable to larger private equity firms that are looking for firms in the next level, if you will. Which is a great segue for my question for you, Morry, because um, you've worked with transactions for public companies and larger, even billion-dollar companies in those transactions. How are you seeing a similarity? How would you compare those transactions to what you've seen in the CPA industry?
Yeah, I mean, I think at the core, regardless of the size of the transaction, in the end, if you take a business to market with the intent to sell, what you're doing is you're creating a market for the seller, right? And you're bringing a number of buyers to the table. What that process does is provide price discovery. So we can give preliminary estimates and talk through kind of what we think valuation is, and we can look at comparables and all of that. But at the end of it, a firm is worth what someone is willing to pay at any particular time, right? So the process involved is similar. Obviously, you have differences in the level of diligence and the exact setup with the process, but in the end, it's trying to accurately value a business and result in a scenario where the seller is happy with their outcome because they get the cash they're looking for, they get the fit ideally that they're looking for, and they have some incentive to stay on in the case of private equity, because again, that does tend to be one of the things that matters is looking for a retention of in the 3 to 5 year time horizon. So those parts I think are similar. I think you do get into situations sometimes, depending on which firms you're working with, right, where you can have fit issues, because if you have a private equity firm that's looking at it from the standpoint of, hey, we're going to diligence this like it's an institutional deal that's a $1 billion deal, that's not really realistic, right, when you're talking about a smaller firm. So I think you do get into some of those kind of quirky elements, and I think we can talk a little bit about that more when we get into into talking about fit between the buyer and the seller.
Yeah. Yeah, we've definitely seen some due diligence lists that were pretty overwhelming. Yeah, those are good points. And what do you think is the essence of the roll-up strategy? Do you think some of them are just almost laser focused on, hey, we got to scale and get to a certain earnings level, certain revenue level, so that they can then have another exit and have a liquidity event?
Sure. So if you think about how they operate in general, right, they've pulled together a large amount of capital from large investors, and then they take that amount of capital and they go into the sector. What they're seeing in the accounting practice world is highly attractive, cash flow dynamics, and so they feel like the value is there. So it starts with a value approach. As you go to roll up an industry, and there's numerous examples of the roll-up strategy that's gone on for 4 decades. At its crudest form, you're just building scale, and you're adding no value other than scale. Scale itself is a value, of course, right? Because you do get efficiencies, you can negotiate better deals with vendors, you can streamline operations, there's a lot of efficiency. So scale on its own does add some level of value. I think if that's the only thing the private equity company is doing, they're leaving a lot on the table, right? And so I think the more informed ones and the smarter ones, what they're looking to do is to make the whole better than the individual parts. So you can imagine, let's say there's a tax practice out there, and they don't do any bookkeeping, right? Well, if you've got a core there and then you put it together with somebody who does do bookkeeping, right, now you've got more than just the financial metrics of the two involved. I think when you start talking about synergy, that would, to me, tell you that you're talking, and I'm talking about revenue synergy first before we get into the cost side. I think you're talking about, with a private equity buyer who at least has a strategy that is beyond just pure blunt force scale. And I think the likelihood of that vision playing out is stronger, right? There could also be, any number of other angles that they could bring to the table. Perhaps they're experts at digital marketing, and they just feel like, if I've got the backbone, right, I can just plow out digital ads and really increase the revenue. Maybe they have that capability, maybe they don't, but at least they have a strategy around how to do that, right? I think it would be very important, if I'm a seller, to understand what that vision is. It doesn't mean that everything they say is going to come true, but it just at least means that they have some vision that is not just, if all you're doing is putting up scale and then just cutting the cost to the bone, that's probably not going to be a pleasant place to work. Right.
Yeah.
So I think the way that they're approaching it, are they trying to grow the top line at all? Or are they only focused on how can we cut cost all the way down? I believe that will kind of give you a little bit of an indication of where they think they can add value, because that's what they're going to do, is they're going to turn the screws where they can add value. And the more that's revenue focused rather than cost focused, if I'm a seller, I think the better headspace I'm going to be in working there.
And the whole idea of knowing the buyer's vision, I think, applies to any buyer. And what I've been selling CPA firms since 2003. And I can say without a doubt, the buyers that have a really clear vision, that they can share that with the seller, and the seller is aligned with that vision, that's usually when deals are just sort of a really good fit, I think. And that vision is important. And a lot of these private equity firms, I don't think they've quite fleshed out their vision yet. I think they're still learning right now. we're at an early phase in this cycle where there are a lot of people out there that are just figuring all of this out and figuring out the industry, getting an understanding of the industry. A lot of these buyers from outside the industry really don't understand the industry very well.
Well, and to your point, the way that the money flows, right, is that you raise a PE fund and you have sort of an objective. So let's say I raise $100 million to go acquire, or get commitments for that to go acquire CPA firms, right? I've got to deploy that capital because I've got return hurdles, right? And so they're always thinking about how they're going to make money for the portfolio because they only get paid on percentage, right? So that money has to start going out. And to your point, Brandon, I think that can sometimes happen before the full strategy is very well articulated. The way that would impact a seller to me is also evaluating, are you being acquired to be sort of like the core operational backbone? Like, do you have a really efficient practice, right? And so they're going to bring you in and say, hey, you're the backbone, and we're going to expand these best practices out to others. Okay, that's one situation, right? In that place, I'd say the seller is in a very attractive position because they get to sort of, with the mothership of the private equity firm, they get to sort of impose those those practices onto the other businesses. However, if you've got a practice that maybe is light on cash flow percentage relative to the industry or has some other kind of operational inefficiencies, then you've got to be honest about that with yourself. And you've got to understand that those are probably not going to be tolerated under a private equity ownership, right? So that means that they're going to be applying somebody else's best practices to you. And, you've got to be okay doing that if you're in that position, or you've got to say, you know what, my practice, isn't ready for that. And maybe private equity is not the best fit if I'm not, flexible to incorporating other people's practices into my business.
Yeah.
I think also too, like there are so many new people coming into the industry that I think as a seller, like asking those type of questions, like as far as number one, what kind of structures and systems does the private equity already have built? Like, and have they figured out who's part of their team and investors? Because we have actually seen where sometimes buyers, like actually who the partner is, changes. And so they're not even stable in figuring out what is their vision, who are they working with, and all those things. And you really want to make sure, that they have that in place. And you can get a very good sense by understanding more about their process, their vision, what is their plan, and who are they working with.
There's an element of what you just said that's like a board of directors in a sense. If the board of directors of any large institution is, cohesive and has a shared vision, then things can operate very efficiently, right? But you're absolutely correct to the extent that that vision is not fleshed out, to the extent that they have different, different LPs coming in and out. What capital do they have committed? What's in the fund? What is sort of committed after that? How firm are those commitments? There's a lot of topics like that as you go through the fit part of the conversation that really do matter because once you're underneath their umbrella, it is very much like a corporate environment where, if you're a VP or an SVP or, even if you're a C-level employee at a large institution, you're not necessarily making the decisions if depending on how the board operates, right? So they form that layer. And I think that's an element also that any seller should think through as they decide whether or not to get involved.
Yeah. And there are firms that can help the seller exit pretty quickly if that's desired. So you don't have to necessarily work a 2-3 year workout period. There are PE firms that have the capacity to take a seller out more quickly than that. So,
yeah, and in some cases they could just be looking for the book of business, right? Particularly if it's an adjacent sector. So let's say they do they've acquired practices that focus on real estate, right? And then you have a particular subset of real estate. Like maybe this is just particularly if you are if you're a developer who does hotels and they see a practice that has that, but that person doesn't want to stay on for more than, a year or so. Those things can often work because again, once you start getting into revenue synergies, I believe that's kind of where the smartest private equity people tend to play.
Yeah. And there are some really smart ones out there. I asked the question to Lawrence about, it's not for everybody. And there's kind of a little bit of a negative impression right now, I think, in the industry. And I have met personally some really visionary leaders in PE that I think are going to do really wonderful things for the firms that they acquire and the firm that they ultimately build. And I think it can be good for A player staff, and it can be really good for business clients that aren't getting what they need from the CPA industry now. And that's one thing that I've observed, is a lot of accounting firms are just not delivering business clients what they need. And so they've opened the door for someone who's going to run these CPA firms a lot more like a business. They're going to run them in a way that's going to really optimize those firms.
Hey, Accountant's Flight Plan listener. Are you thinking about selling your practice or curious about how much your firm is worth? Having sold firms for over 20 years, we've seen 8 key factors that come into play when determining the value of a firm. Download our free Valuation Key Factors report to assess your firm's value today. You can find it by searching Poe Group Advisors Valuation Report or visiting PoeGroupAdvisors.com. Thanks for listening, and now back to the episode.
One thing that this is all impacting is it changes the supply and demand equation in the industry. So you've got more demand for practices right now with private equity coming in. And so we're seeing valuations go up. So Lawrence, you probably have seen some of the most surprises on our team where we've priced deals at a certain level thinking, okay, we're really pushing the envelope here, and sure enough, they sell. And so I would say we're still in a market that's moving.
Yeah, I mean, definitely this year hit some records as far as multiples, and even compared to the spring, we're hitting higher multiples than we did even 6 months ago. So it's definitely a moving target. I think we're definitely seeing EBITDA in multiples go up. Same with revenues. Again, every firm, there's so many factors that we look at. So that plays a big role, including like owner hours. Do you want to stay on? What is the cash flow? What do your employees look like? But yeah, even some of the prices we've been getting, I've been surprised by. So it definitely makes it a fun and interesting ride. But I think for a seller, like really what you want is to have multiple buyers, multiple types of buyers, so that you have kind of the option and also negotiating power to increase not only the terms, but also be able to pick who you really feel like is gonna be the best person for you and your team.
Yeah. Well, and if I could react to a little bit to the valuations kind of even moving higher from the spring to the fall, right? When you see those types of things that don't sort of, make pure economic sense, right? The valuation of something has very little to do with any sort of fundamental analysis. It has very much to do with how much capital is chasing, that sector. And so it is not that CPAs are fundamentally worth more today than they were two years ago. It's just that you have a lot of pooled capital coming together to go chase those assets. So right now, if you're a seller, right, you're the attractive house on the block, right? Because we're in a sector that has positive fundamentals, and so the capital is chasing that, and so you will see scenarios. And I would say, in every sector where there is this sort of consolidation, there is also a cluster around the very, very top end firms that get a premium, right? So think of what's happened to beachfront property over the last 20 years, right? It's the same thing. If you have a very, very high quality practice that has, metrics that screen high versus competitors, and if you've got a high revenue base, you're in the single most attractive part of the market. They tend to focus on kind of $5+ million deals. We have seen some deals done, a little bit below that as well, and they're increasingly kind of bringing the lower level more into play. And as Lauren said, there's a lot of different factors that are also not purely quantitative, right? The depth of the bench, at your firm, that's going to matter. The quality of the firm owner, right? Does the private equity group, do they see this person as a leader in some way? It doesn't have to be in one way, right? Is it a leader in possibly biz dev? Is it a leader in being a manager of people? Is it a leader in, an expertise in a certain niche of accounting that most people don't have? Like, there's all sorts of ways to add value. And again, I'm going to say fit, which we're going to probably say 100 times on this video. It comes down to really being honest about what your own skills are as a seller, and then making sure that fits with the vision of the private equity firm.
I will say that one thing I think that is a little bit different is I think that owners do have more of a pricing power that they did even a couple years ago, right? There's just not enough CPAs coming into the industry. And I think that's part of the reason why private equity has realized that, like, maybe even before certain owners, like, you can go up in prices 10-20%, like, and even higher in a lot of cases if you're not doing that consistently, because there's just not enough CPAs in the industry. So I do think cash flow can very easily increase without having to even get new clients. You just work on focusing on some of your current clients, ideally offering additional services like tax advisory, and the value really can increase pretty quickly.
I agree with that. We've seen that with our Accounting Practice Academy members who've gone through and experienced what it's like to have that pricing power. And most CPAs that we've helped increase their pricing have been really surprised at how little
you've had
pushback.
examples where they're like hundreds of thousands of dollars more a year on the bottom line, and then we're also getting hundreds of thousands more in the asking price.
Yeah.
And that's within 6 months to 6 to 12 months. So it can happen even very quickly.
Yeah. So, yeah. And I think the smart PE firms are going to test that pricing model, and they're going to push that pricing model. And to your point, they're going to increase cash flow and revenue in a pretty easy fashion. And if you're a CPA that's not ready to sell, that's something to think about is optimizing your firm before you want to sell. Let's talk a little bit about some of these offers that we've seen. And Morry, you've kind of likened some of these offers to like NFL contracts as a good kind of example that people are familiar with. You want to expand on that a little bit?
Yes, I like to think of it like that, because you'll often see a headline of like $100 million deal or something like that, say with a football player. And if you look through the details of it, though, it'll be like, 15 or 20 million guaranteed. And then the rest is subject to, continuing to play for a certain number of years, certain incentive metrics. And then, yes, if everything aligns, you get the 100 million, right? I think very much the same way in private equity, what they will tend to do is to give you an offer that says a very, very high headline number, right? So let's say you've got a $5 million practice. They might send you a $15 million offer, and then that sounds pretty good. But if you look into it, it's very much determined by how much cash do you get at close? What type of employment agreement are you looking to work out? There's a fixed income, a fixed compensation component of that. There's a variable compensation component to that. There's likely an equity compensation component to that. The thing that's positive about the future earnout items is that given what we've just talked about, the supply demand characteristics in the space are very positive, and I would assume that rates continue to move higher because as the sector continues to consolidate, more and more will be moving higher. And because of the recurring revenue nature of the business, that can be positive. But it's important to sort of make sure as you're going through those offers that you're evaluating apples to apples, right? Because it could be that the smaller headline deal that has more cash guaranteed is going to be a better fit for you. So it all comes down to what your goals are, and I would say those are often outside of the monetary side, right? If you're honest with yourself about the non-monetary goals, I think that then it makes it fairly easy to look through the numbers and kind of get to the right fit for yourself.
Yeah, Lawrence, you've had a couple of clients, have some of those big headline offers, and they've ended up going with other buyers because of just what Morry was saying. It was like when they
Yeah, and when we talk with sellers, we definitely like what is the guaranteed amount versus, because there are usually can be components of here's an earnout, here's a what here's if you grow 20% every year for the next 5 years, then this might happen. So we look at that, but really what we're looking at is the guaranteed amount. We're also looking, I think a seller should really look at like, do they have a proven track record of doing that? How long have they been in the industry? But really it's what is like the guaranteed amount. And again, when you're talking to at least multiple buyers, then you can go back to them. And a lot of those have actually like changed their offers and made all cash offers because the demand is much higher for these firms, and we're able to bring multiple buyers to a seller. So yeah, you definitely have to break down, because the big headline number when we've even gotten offers that are 3x what our asking price is, but then when you break it down, it's less.
Not so much.
Yeah.
Well, and I think that's a really great point to talk about, Lawrence, in the context of having options. I've heard sellers talk about, I'm talking to a private equity firm, right? And kind of, they've made an offer. And if you ask them what the offer is, what they will tend to do if you are not working with a broker and they feel like they can kind of see what you're willing to do, is they will often, again, offer you this headline large number, and then it might be 10 or 20% of that at closing, right? So they're asking you to take on a lot of risk. And the reality is they have far more market information than you do as an individual seller. And so to negotiate with them one-on-one is a very, very challenging thing. If instead, though, you've got a pool of possible buyers to leverage the information against, now you are the one who is in control of the information, and now you have more information than they do because you've got other parties to the table. And so that allows you to just immediately rebuff offers that are ridiculous, because the private equity companies, if they're going out there, again, they're looking at it from a portfolio approach, right? They don't always care so much about the individual practice so much as they care about the whole. So if I'm a private equity investor and I go out and I make an offer to 10 different CPAs, right? It's 10% cash at closing, everything's on earnout. I'm taking no risk, you're taking all the risk, right? If I make that offer to 10 people and 3 or 4 of them jump at it and the other ones turn me down, I've already won. Right. So they're playing the information asymmetry game. And so it's really important if you're negotiating with them to make sure that you have other parties at the table, so you're not at a disadvantage.
And also some of those, like I've had where I've told some of the buyers, like this is actually the worst offer. And when we have multiple offers, they've then changed their offer of what they typically do to actually be the best. So for the right firm, they will change their offers, even though they would not do that individually.
And often that's because the seller steps to them with good information, right? Because they now have market knowledge and they can say, oh, that's not what I'm hearing over here, right? And as soon as you step to them with that, now in their head, they've removed you from the box of an unsophisticated, seller to, oh, These people have information. Now I got to actually make a market deal.
I always kind of think of it a little bit of like trying to sell your house on your own versus working with a realtor, right? You just open up that scale of how many people are viewing and who viewing the information and who you're talking to, and, ideally getting multiple offers. So it just gives the seller more the power.
Yeah. Well, with that, I think we've had a really good chat about private equity. We're probably going to do some more of these chats. The market is changing. We've got a new white paper that should be out by the time this gets published. So look for our blog for that. We'll put a link into the show notes. Also, I want to close off with, I always do this on my podcast, is like, what are people reading? So think about what you want to recommend. If you've got a book or two that you're currently looking at, I'll share mine. So I did a presentation in Detroit this summer, which was an interesting place to visit. And we went to the Motown Museum, and I picked up Berry Gordy's book, his autobiography, To Be Loved. And it's really incredible. He's a very entrepreneurial guy. He started Motown from scratch. Who wants to jump in? Any book recommendations?
I can jump in. I have not been reading much the last 6 months. I've been slammed with a number of things. However, my favorite book to recommend is also music related, and it's Keith Richards' autobiography. It's called Life, and it's if you like music or the Rolling Stones, it's amazing. But it's also awesome. It's an awesome generational differences, because some of the things, and like just imagining any of those things happening, from the 60s and 70s happening now, it is just shocking to read the differences in society and how much differently it's organized now versus then.
Yeah, it's good.
I would say one, I'm actually like rereading it, but is Shoe Dog by Phil Knight, which is about Nike. I just always find that a fascinating story, and just the ups and downs. And, you see these big companies and always think that it's always been a success. So it's nice to kind of hear like how many times it almost failed and all the different problems. But it's a very easy but fun book to read.
And Phil Knight was a CPA, and most people don't realize that. But yeah. So, all right. Well, thanks, guys. Thanks for joining.
Thank you.
Thanks for listening to the Accountant's Flight Plan podcast. You can keep the momentum going by subscribing and sharing your thoughts with us. Visit our website at pogroupadvisors.com for more resources, and tune in next time for more exciting conversations like this one.